we have a strong heritage and lineage of being able to really help people understand why cash value insurance isn't good for them. So we're not going to spend a lot of time on this, but I draw a little bit of a graphic here. So I see somebody has cash value insurance. The best thing to do is to get them to get their policy and to just show them in their policy, right? Did you know this? Did you know you're not going to get both? Did you know you have to borrow your own money? Did you know, right? And just go ahead and show them in their policy. But in the event that they don't have their policy readily accessible, here's the presentation I use. So I say, great, so let me give you a couple-minute tutorial, Bob, if it would be okay, on how your cash value insurance policy works, okay? Because I want you to make sure you understand it, because I believe that when you understand it, you're not going to want to continue with it and you're going to want to do something different, okay? So cash value policies are very, very expensive. They're many, many times more expensive generally than an equal face amount on term insurance, okay? So it's very expensive. And the money's going in two sides, okay? Side one is an insurance benefit. Let's just say $100,000 face value, okay? The other side is a cash value, okay? So there's two sides. Money's going to insurance and then a cash value, okay? There's three problems with the cash value account that the insurance salesperson who sold this to you conveniently forgot to mention, okay? So I'm going to share those with you. I just want you to think them through to see if you understand them. The first problem with the account is for the first 2 to 5 years, every dollar that goes into the cash value, okay, is taken. The insurance company takes it. It's not available. So let's imagine, and this is not a bank account, okay? This is your cash value account. But let's imagine, let's use an analogy, so to speak, of going into a bank. Okay, because you put the money in here, into this account, all right? So you walk into a bank, you name the bank, where do you bank? And I ask them, where do you bank at? They say, oh, I bank here, I bank there. I use that bank. I say, Bob, if you walked into, ABC Bank and you open an account with them and they say, Bob, we're so thankful that you're doing business with us. We're looking forward to a lifelong relationship with you. But just so you're aware, we won't plan on seeing you for the next 3 to 5 years. Because if you come back here to get your money, there won't be any here. We're going to take all of it, every cent that you deposit with us in the next 3 to 5 years. So we'll see you in about 5 years. We look forward to talking to you then. If the banker told you that, would you ever open that bank account? And Bob said, well, of course I wouldn't. I said, well, unfortunately, you just did when you bought this product, okay? So the second issue is the only way you can get money out of this without surrendering your policy is to loan it to yourself at interest, okay? So whose money is in this account, Bob? It's your money, right? Okay. Have you ever heard of having to pay interest to use your own money? Probably not, right? Okay. So imagine we walk back into ABC Bank and they said, Bob, Susan, man, we're so glad to have you as clients. This is going to be a great relationship. But if you ever come back here for $1 of this money, we're going to charge you interest till you pay us back. Would you ever open that bank account, Bob? Susan, would you ever open that account? No, of course you wouldn't. But unfortunately, you just did when you bought this, okay? But it gets worse than that, okay? And the third issue is really worse than both. And that is when you die, you get the choice, not you've passed away, but your family gets a choice of the insurance or the cash value. They don't get both. The only exception to that is on a variable policy, universal policy, where they have an option B death benefit. Okay, it's an extra expense. They are out there. It's rare. They're paying even more than the already huge, gigantic premium they're paying now. Okay, but by and large, most do not have a cash value plus insurance. Okay, so you get the choice of the insurance or the cash value. Okay, so at age 100, generally the insurance and cash value are supposed to be equal, right? So the insurance would be worth $100,000. The cash value would be worth $100,000 at age 100, right? So let's pretend you died at age 80. Okay, it's not going to quite be $80,000 because of interest and other things, but let's just use the round number of $80,000 in cash value and a $100,000 death benefit. So you pass away, your family gets a choice of the $100,000 or the $80,000. So which would they pick? Well, they'd pick the 100, right? And at first glance, Bob and Susan, most people would say, well, what's wrong with that? I bought a $100,000 policy. They paid my family $100,000. Let's watch the math here. So the insurance company pays out the $100,000 death benefit. But they get to keep the $80,000 in cash. So they pay out $100,000, but then they take over your $80K. So how much does the insurance company in this example have to pay? The insurance company paid $20K, their own money, and offset the rest of the death benefit with the cash value they were able to keep. So you paid for how much insurance, Bob? You paid for 100. But how much insurance money did you actually get? In this example, you got 20. So Bob, you're paying for two things, insurance and cash, but at any one given time, you only get one thing. So you understand why you don't want to have this? Bob and Susan, of course you do. Great. Let's go ahead and get you started.